For our example, we'll use an imaginary building company. The first part of the balance sheet is the equity or the owner's interest in the business. You can see here that last year, the company made a profit of 71,554. But this year, it made a loss of 45,857. Total equity is 2,087, which means if the company makes a further loss, it will be insolvent. Strategies to improve profitability need to be implemented urgently. We'll build a balance sheet as we go to help you understand the layout. The company has a bank current account, but you'll see shortly that it's also running an overdraft. A current account like this is a great way to build up cash reserves for tax payments and any further downturn in trading results. There's income tax receivable of 5,375, which means there's too much tax that has been paid during the year. So there is a drain on cash flow. The opposite can also happen when there's a surprise tax liability, when the financial statements are done, which can put pressure on cash flow. Having a regular update of your tax position throughout the year helps ensure you don't pay too much or too little tax. Stock on hand has increased by 33,862, which is a further drain on cash flow. Holding too much in stock can put pressure on a business as the stock first has to be sold and then the funds collected from debtors. On the flip side, work in progress has reduced by 47,531, which is good news as the higher the amount tied up in unfinished work, the longer your cash is tied up. In this example, work in progress is the value of wages paid on jobs that cannot yet be invoiced to customers. The shareholder advance account is showing as an asset of 66,494. In other words, the shareholders owe almost 66,500 to the company. This isn't good because if the company fails, a liquidator or receiver can demand this money from the shareholders, and they won't have the protection of limited liability and will be personally liable. We can see also that the balance owed has increased by 32,504 this year, which indicates that shareholders are taking more cash out of the business than what they're entitled to. Accounts receivable, or debtors, have reduced to 82,628, which has freed up a bit of cash compared to last year. By referring to the trading account, we can calculate that this is taking 48 days to collect debtors. If payment terms are 7 days, there's a significant amount of cash tied up here. There's very little value tied up in fixed or non-current assets. This could be a signal of eroding value, as fixed assets have dropped by 23,588. In other words, some fixed assets could be in need of replacement, so there could be future drain on cash reserves when assets need replacing. Although the total reduction in total assets this year is only 15,492, the reduction from 29,982 down to 282,490. We need to remember that one of the assets that has increased is the debt owed by the shareholders to the company. The true asset reduction, excluding the shareholder advance accounts, is in fact 47,996, which is of major concern.